This is a podcast from BFM 89.9, the business station.
BFM 89.9, good afternoon. I'm Roshan Kanase, and you're now listening to Enterprise Explores, the show where we help you navigate the ever-changing universe of business from the headlines to the bottom line. Central banks globally are cornerstones of our modern economies, primarily tasked with monetary policy and price stability, i.e. managing inflation. But what if this core mandate isn't enough? Our guest today challenges this fundamental premise and argues that monetary policy needs to go beyond price stability, calling for a rethink of monetary policy, urging central banks to step back and allow market forces to truly govern. So what's his view for a truly stable economy and a perspective on his policy recommendations and whether they're practical for today's world? To unpack his thesis and more, on the line with us, we have Economist Dr. Carmelo Ferlito, CEO for the Center of Market Education. Carmelo, always good to see you. How are you doing?
Hi, I'm good. Thanks for having me, and thanks for allowing me to talk about this topic, which is a bit more abstract than what we discuss usually, let's say, and not strictly related to the Malaysian context.
You always have a great way of getting my attention, Carmelo, and this is one particular paper that was particularly interesting. So, why does modern monetary policy need a radical rethink in your view?
Well, you see, while I consider indeed monetary stability and price stability a very important target, so I don't want that the audience get misled about this. I truly believe that price stability is an important target. I also believe that more attention should be paid to the consequences that monetary policy has on the real economy. So not just on the financial aspect of the economy and particularly on prices, but more radically on the coordination between consumption and investment decisions. So the consequences on the real circuit of the economy, let's say.
So price stability is important, but we need to be paying attention to some of the downstream impacts of such policies. So taking into consideration that price stability is important, what else should monetary policy be aiming for then?
Well, I think that, as I mentioned in the paper, the paper was devoted to two targets which were called social welfare and sustainable growth. In this case, I have adopted, I would say, a rather loose definition for this. And in particular, I attach to sustainable growth meaning of an economic growth which proceeds with minimal business cycles, with minimal fluctuations. And social welfare, I define it as the maximum employment that is possible to achieve within a certain defined production structure. So without having the ambitious target that usually Keynesian economists have of full employment, better stable employment than full and unstable employment.
How do your definitions for sustainable growth and social welfare differ from our current situation today, aside from the full employment perspective?
I would say that my definitions tend to be more relaxed in a way, in the sense that I believe that the economy is a living organism, the result of bottom-up forces and processes. So to attach two strict targets and two strict meanings to our actions can result in painful consequences, because it's very...
Carmelo, can you hear me?
Yes, sorry, I don't know what happened with the line.
It just decided to cut you off at that moment there. But we were talking about how your definitions for social welfare and sustainable growth differ from what's happening in the market today. Could you take us through that again?
Yeah, so I was mentioning that basically I believe that the economy cannot be trapped in cages, and so it's very difficult to say I want full employment, I want prices to be at this level, and to link policy actions with precisely defined targets, because that could result in overambitious policies that do not achieve the target we want, and at the same time produce negative unintended consequences.
And you've got this very bottom-up perspective that you prefer over a top-down perspective, right?
Correct. So the economy is made of human actions, and interactions, and as such is an emergent order. Is not something that is thrown down from the stars. And when attempted were down to do so, the results were not really desirable, let's say.
So this goes on to one of your key points that you advocate for in the paper, which is humility in economic policy making. What does viewing the economy as this complex, evolving system then mean for policy making?
Precisely this. I mean, I think one of the biggest temptation that I see in policy making, and on this, I think economists are guilty as well, is that they see a problem. Let's say unemployment is 3%. I want it to have a 2.5, and I design a policy that within a certain time frame will bring me exactly there. So humility, first and foremost, means that the reality doesn't work like that. We don't have an engine. It's not like I'm in a car. You can switch it on, switch off, take out pieces. Is something that is more living. Indeed, is a living organism, and therefore we need to be very careful and define maybe less ambitious targets, but which respect more the bottom-up outcome of interactions between people.
That's fascinating, because I guess, especially when you go to university to study economics or business school, a lot of it is very formulaic kind of interpretation of what the economy looks like. Do this equals this, ceteris paribus, right? Do you think that's a key misconception that we have about the economy, that it's all these numbers just equal this equation?
It is, and in fact, I believe that the biggest sin of economics in the past 4 decades, probably 4 or 5 decades, has been a radical shift from understanding to measurement. So we became obsessed with measuring and finding functional relationships among variables, rather than humbly trying to understand how this living organism works. And obviously, we need those abstractions, those ideas that if, in example, I increase the quantity of money, then prices will increase. Or that if the demand increase, then prices will increase. So we need to have that simple logic, which is true, which is works. But the way in which this logic works in reality is not so instantaneous, linear, and straightforward like it happens on the graphs, on the whiteboard. So the whiteboard is helpful to make us understand certain dynamics, to abstract from reality to get the bigger picture. But then when we want to act on reality, we have to understand that the whiteboard cannot just be applied on it.
And Carmelo, to be specific here, you're talking about a global view on monetary, on this, right? It's not just a local or regional view.
Yeah, absolutely. I mean, my reflection actually is a reflection that started to revive an intellectual reflection on monetary policies that goes ahead from the past probably 150 years, since the time of Knut Wicksell, and then Hayek, and also recent authors. So, yeah, it's the attempt to revive that intellectual tradition, let's say.
Carmelo, we've got more to get into, including a better understanding of monetary policy and its core concepts, but also, more importantly, diagnosing monetary disorder, as you point out in the paper. Folks, this is Enterprise Explores, the show where we help you navigate the ever-changing universe of business. And today I'm speaking with Economist Dr. Carmelo Ferlito on his argument for rethinking monetary policy beyond just a view of price stability. I'm Roshan Kanasan. Keep it here to BFM 89.9, the business station.
Bulldozing fine measures. BFM 89.9, the business station.
BFM 89.9, welcome back to Enterprise Explores. I'm Roshan Kanesan, and today I'm speaking with Economist Dr. Carmelo Ferlito. We're taking a view at monetary policy and why he believes it needs a rethink across the globe. Now we're taking a step back and understanding the core concepts of monetary policy before we go into his concept of monetary disorders and how that's led to inflation, currency instability, and asset price bubbles. Carmelo, the understanding of monetary policy isn't as deep for everybody here. So what is monetary policy in the modern context, and perhaps how has the practice evolved over recent decades?
Well, you see, this is not an easy question, but let's say that usually monetary policy is associated with the control of prices, and historically was more associated with the control of the quantity of money. We see it actually usually interpreted in the mind of the people with a simple relationship. When there is inflation, the central bank should raise the interest rate. When there is an economic depression, the central bank should lower the interest rate. So let's say that in modern decades, the main tool of action of monetary policy has probably become the signaling function that they exercise by fixing the reference interest rate, and this is, let's say, historically speaking, quite a recent trend. Obviously, in the past, there was more attention to the direct quantity of money, and these emphasis have been abandoned. Also, let's say that most recently, the idea that the quantity of money is related with prices has been less paid attention to, unfortunately. And I would say that the modern way to see monetary policy as the main controller for prices, and associated also with a certain fear for deflation, is a link with a meeting between central bankers that happened just after World War I. So this is the turning point. And obviously, if we come more recently to the recent decades, another big turning point is the abandonment of the gold exchange standard in 1971. And in fact, there has been a higher inflation since 1971 until today than in the previous millennia of the history of mankind. So that has been quite... but obviously, it's not related only to monetary policy. Fiscal policy plays an important role, because in the moment in which the link with gold has been vanished, then there has been no limit anymore for governments to increase the quantity of money via excessive spending.
So going back to the gold standard, the lifting of that or the removal of that allows then for money supply to be more directly leveraged as a monetary tool.
Absolutely, yes, because then an automatic link, an automatic limit was just removed, and that was the last limit that was left, and this has allowed the fiscal policy, to go really beyond the limit. And in certain countries, this was aggravated by the fact, I have in mind in particular my country, Italy, up to 1992, there was the obligation for the central bank to purchase all government bonds that were going unsold at the normal tender in the market. So this, of course, brought inflation in Italy at that time totally out of control, and a huge devaluation of the lira at that time. Unfortunately, in 1992, this perverted mechanism was abandoned.
So central banks play a big role, needless to say, but primary functions include influencing interest rates and, as you've pointed out, to managing the money supply. Talk to us about that role that they play.
So let's look at the interest rate as the most common tool in monetary policy. We obviously don't pay or don't receive that interest rate, that specific interest rate, which is fixed by the Central Monetary Authority when we put our money in the bank or we get a loan from the bank. But that rate becomes a reference rate for all our actions from banking institutions. And that rate being a reference rate somehow is going to affect all the investment decisions, so big spending decisions and all saving decisions. So we, and this is the most critical point in the paper, somehow we have the most important decisions, or some of the most important decisions in the economic system, in our economic life, which are guided by a price or by a signal, which is not arising or not ultimately dictated or solely dictated by market forces, but is guided by policy.
And you've mentioned two key terms here, fiscal policy and monetary policy. What's the difference here, Carmelo?
Fiscal policy is the way in which government decide how to collect revenues and how to spend the money that are collected and also the money that are not collected, unfortunately, while monetary policy is more related to the control of prices and the control of interest rate, and via the control of interest rates. So, and in fact, this is a point that I've tried to make in several occasions. Even if we limit monetary policy to the narrow focus of controlling prices, this control will be ineffective without a stricter control of fiscal policy, because ultimately, I do believe, like many other economists, that price dynamics is related to the quantity of money and to the speed of growth of the money supply, but it is not the central bank that control money supply. Ultimately, governments and commercial banks have a higher control on money supply, on the quantity of money that is injected in the system, than the central bank does. So we tend to overestimate what the central bank can do and to underestimate the disasters that wrong banking policy and wrong fiscal policy can do in terms of price dynamics.
So in terms of money supply definitions, those issued by commercial banks, that would be M2?
M2, yes.
So as part of the money supply. Overall, then, Carmelo, how critical is fiscal discipline then to the success of monetary policy?
It's crucial, is everything. And in fact, one of the things that I advocate for in the paper, not being particularly original, I'm not the first one advocating for that. There's a long tradition with James Buchanan, in example. I advocate for a constitutional limit to the possibility of governments to issue, to spend in deficit, and to introduce the principle of balanced budget as a constitutional principle. If we don't control fiscal policy, again, the control, the action of monetary policy will be somehow undermined.
Carmelo, how would that look like, and why is that so important?
Because ultimately, an excessive growth in money supply increase prices, and this means simply that makes everybody poorer. To speak in very simple terms, it means that you believe to have maybe more money because the government has given you aids and subsidies, but the way in which those aids and subsidies are financed matters. So if they are financed via money creation, actually the real value of that money will deteriorate fast.
Carmelo, we'll take a quick break, and when we come back, we'll talk about diagnosing monetary disorder and some of the key terminology here, including inflation, currency instability, and how this leads to asset price bubbles as well. Folks, this is Enterprise Explores, the show where we help you navigate the ever-changing universe of business. And today I've been speaking with Economist Dr. Carmelo Ferlito on his argument for rethinking monetary policy globally beyond just price stability. I'm Roshan Kanasan. Keep it here to BFM 89.9, the business station.
Bright, formidable media. BFM 89.9, the business station.
BFM 89.9. Welcome back to Enterprise Explores. I'm Roshan Kanasan, and today I'm speaking with Economist Dr. Carmelo Ferlito, CEO of the Center for Market Education, on why he thinks monetary policy across the globe needs a radical rethink. We're now turning to monetary disorder and how it manifests through inflation, currency instability, and asset prices. Carmelo, in the paper, you use this term, monetary disorder. What do you mean by that?
Well, what I mean there is that when money injections happen in the system which are not reflective of market forces, let's say, these money injections create effects on the real economy circuit, and they don't remain isolated there. In turn, from the real economy circuit, they transmit to the financial circuit, and they can take the shape of monetary disorders. And I give you an example. If we look at how the 2008 crisis arose, this was the result of actually an excess money supply that was created through low interest rates after the dot-com bubble. And this was done in the hope that the economy depressed from the dot-com bubble would revive, but the effects would not remain limited there. The excess liquidity created as bubbles, specifically in the real estate sector, and new speculative practices took over, and this is the Minsky financial instability hypothesis, and these asset bubble prices eventually burst. So we see a transmission from money, real, money, and real again. So this is, in a nutshell, how I would define monetary disorders.
That's so interesting, right? Because we look back to 2008 and what led up to that, as you mentioned, the financials, the banks created new products because of the low interest rates. They couldn't make money from interest rates, hence leading to things like possibly leading to things like CDOs and other more risky products to generate margin, which is a fascinating view at the impacts here and monetary disorder and asset bubbles. So that's a view at asset bubbles, Carmelo. What about the other two parts of monetary disorder which you name, which is consumer price inflation and currency instability? What causes them?
Is basically the same, yeah, because it's similar. Even if we we didn't observe, in example, consumer price increase at a very high level during those years. But there was a restructuring of relative prices. So that was generated by the same monetary injection. And it was due to the fact that resources were allocated more to capital-intensive projects due to lower interest rates. And this created a dichotomy with the consumption sector, and therefore the inability, in example, for consumers to buy what they wanted because what they wanted didn't exist. This was called forced saving. And the same when there is excess money in circulation can take the shape of how do you call it, the currency disorder. And this is what, in example, we have experienced with the shaking of the Asian currencies last year. Again, this is because of the excess money that was created during COVID, the COVID emergency, and this has taken the shape of a bubble in the high-tech sector, but also speculation over currencies.
So currency instability and asset price bubbles can still manifest as disorders even with stable consumer prices. How does it happen?
And that's precisely what we have seen, an example with the 2008, because then the outlet, let's say, that excess liquidity takes is not in an increased demand for consumer prices, but in speculative practices, in example, in assets, following certain momentum. We know that the dynamic of speculation, of stock exchange speculation, follows also trend, sentiments. So there is somehow, if you want to call it like that, an irrational motivation. So we can't really control where this fever will eventually manifest. And in the case of the 2008, as you mentioned, banks were extremely creative in the way which they try to make money.
Now, one of the key things you note in the paper when we're talking about monetary disorders is that resulting monetary cycles then led to distorted investment decisions. How do they misallocate bubble and then lead to these unsustainable booms, Carmelo?
So the idea is that, and basically the core structure of the paper is that interest rate should be market determined rather than guided. So without this premise, we don't understand the following reasoning. As I mentioned earlier, today investment decision and consumption decision are somehow guided by a price which is not market determined. So what happens if we have to make investment decisions which are guided by a price which is lower than the price that would emerge from market forces, that we are driven toward excess investment decision. And by investing where we would have not invested in normal circumstances, we push to employ resources that were previously unemployed. The capital could be labor. And this creates a positive cycle for the economy. But the positive cycle brings in itself more demand for capital goods and later for consumer goods, and this ignite the price dynamics for those goods. And so we are driven toward inflation. And therefore, this dynamic of investment can be kept alive only if the mechanism of altered money supply or altered liquidity remain in place. If it doesn't, because of the inflation dynamics, and then central banks are forced to raise back interest rate, then the boom can't be sustained, and then we go back. Then what's happened is a liquidation crisis, which is the necessary remedy to an altered state of the economy, let's say.
So this leads us to your three policy recommendations, essentially, which by your own admission are unrealistic to some extent. So before we get into them, Carmelo, I would like to better understand the underlying spirit or inspiration behind them.
So as the main point is this, as I mentioned, as I hinted now. So we all economists know from price theory that price exercise their information transmission function when they are determined by market. So the more free the markets, the more accurate the price mechanism function is. Now, we have a very fundamental price, which is not just the price actually for the financial market, but a price that reflects, in my analysis, the structure of intertemporal preferences, so how future or present-oriented is an economy as a whole. So that price that we call interest rate is not guided by market forces alone, but has somehow a puppet master direction behind. So how have we allowed over time to have one of the most important prices not to be determined by market forces, but somehow guided by central authority, even if we know from price theory that prices function at best when they are market determined? Why don't we consider this price as all the other prices in price theory? So this is the main point. And obviously, this leads naturally to the policy suggestion, which is we should abolish the central bank directed interest rate. And I myself admit that it would be unrealistic. So it's a theoretical exercise, which is the natural consequence of my reasoning. But I don't think there will be any central bank in the world ready to bet on this experiment. Maybe Javier Milei would be the only one in Argentina that could drive his intellectual influences, which are the same I have, to these extreme consequences.
Yeah, because it does feel like we're too there's too much sunk cost today, right? Since in terms of how much this is a policy tool, the utilization of interest rates. But hypothetically speaking, Carmelo, why and how would this work, right? If the removal of that central bank rate, whether it's Jerome Powell's ability to move interest rates or other countries.
So in that, you don't have the interest rate that disappears, but you have eliminated basically a distortion in the fixing, in the determination of the interest rate. So interest rate will keep on existing, but it will be fluctuating like other market prices, and therefore be more reflective of the intention of savers and investors, more probably. Yeah.
So determined by people, how much people are willing to pay in terms of interest, and how much people are willing to provide in terms of interest?
So basically, let's say that if there is, for any reason, let's say investors become more future-oriented, so they want to embark in long-term investment projects, so there is a positive sentiment in the economy, then they would require more money to be borrowed from the commercial banks. Then, in order to attract to the bank more funds available to be borrowed, to be lent to investors, then the banks will have to raise interest rates to create that attraction power. So we would have actually growing investment decisions. And if those investment decisions, let's say, were somehow speculative or overheated by sentiment, would find a natural barrier to the fact that savers are not willing to put money in the banks at that interest rate. And the fact that interest rate needs to be raised in order to attract saving will discourage partly that demand for investment. So if it was overheated, it will tend to lower down up to meet the desire of consumers to save money. So that would be if now basically we have the situation in which future-oriented investor can find money available even if present-oriented consumers are not willing to put that money there. By removing this obstacle, is not the only obstacle, but by removing that, we had a step in the right direction for a higher degree of coordination between investors and consumers.
Carmelo, you also suggest, in terms of banking, reforms to the banking system to reshape limits of commercial loans. How would this work out and alter money supplies, theoretically speaking?
So I encounter a series of declarations from central bankers or members of boards of central banks, in particular in the West. So we're saying that basically the statutory limits, the reserve limit for banks is basically not enough of a limit toward the creation of money from commercial banks, because in the moment in which you lend out money to consumers or to investors, at the same time you create a deposit under their name in the bank. So the percentage, the amount on which you calculate your reserves is just increased by magic. So I propose to reform commercial banking practices in a way not to keep into account the new creation of deposits. Obviously, this could have repercussion in limiting the available funds for investment, but I believe that this will create probably slower growth, but more stable growth in the long run, which is what we need, less fluctuations.
And thirdly, you suggest moving from discretionary monetary policy to a rule-based framework. Talk to us about this and your hope behind it.
So this reconnects us with the conversation we had at the beginning of the interview about humility. Now we live in a moment of discretionary monetary policy making, and discretion is based on the fact that somehow central bankers or policymakers in general are superhumans and they can have access to better information than other people. Instead, introducing a rule-based system is the recognition of the limit of human knowledge. And so the fact that even policymakers are not that superhumans that we would like them to be, probably, and so they are not able to direct the economy as they want.
Carmelo, any closing comments before we wrap up for the day?
So first of all, thank you very much for having hosted me discussing these the difficult topics. My hope is not really for these reforms to be adopted in the short run, but at least to reopen a conversation about that, an intellectual conversation, a broader conversation on this topic, and to bring in also an intellectual reflection on theoretical economics more at the center of policy making, because we have seen a lot of misconception recently, even when we discuss about SST creating inflation. Consumption tax have that effect, but this is a topic only for a different conversation.
That sounds like a future conversation that needs to be had, Carmelo. Always a pleasure speaking with you. Thank you so much for your time.
Thank you very much for having me.
Folks, you've been listening to Enterprise Explores, the show where we help you navigate the ever-changing universe of business from the headlines to the bottom line. And today I was speaking with Economist Dr. Carmelo Ferlito, CEO of the Center for Market Education, on his argument for rethinking monetary policy beyond just price stability, which he, with recommendations which he himself understands are unrealistic given the modern context. But this has been a fascinating economic argument to have had or to have listened to. And if you missed any part of the conversation, I highly recommend that you go check out the interview wherever you listen to podcasts. Just look for Enterprise Explores by BFM Media. I'm Roshan Kanison. Keep it here to BFM 89.9, the business station.
You have been listening to a podcast from BFM 89.9, the business station. For more stories of the same kind, download the BFM app.